Hello and welcome to lecture number 7. We'll be discussing bond markets. This comes from chapter 7 in your book. So our objectives for this chapter: first, to provide a background on bonds. Second, to describe the different types of bonds and their characteristics. We'll explain how bond markets have become globally integrated and describe other types of long-term debt securities. Now, this chapter should be partially a review if you have attended Finance 3250. Many of the concepts will be familiar to you. So a little bit on the backgrounds on bonds. Bonds are long-term debt securities issued by government agencies or corporations. So what does that mean? Long-term, typically more than a year. Debt securities, meaning the government agency or corporation who is issuing them is trying to borrow money. And so they are selling bonds. It's a form of a loan. When they sell the bond, they're borrowing money, and the person who bought the bond is the one who's lending the money. So the issuer is obligated to pay interest. We call that a coupon payment. Interest payments periodically, such as annually or semi-annually, and the par value, or the principal, has to be paid back at maturity. So if it's a $1,000 bond paying 4% interest, the investor lends the money to the government or corporation, and that government or corporation, over the life of the bond, will pay interest or a coupon payment, and then at the end of the bond, will pay the par value at maturity, so the $1,000 at maturity. Now, not every bond has a coupon or interest payment. Some just pay back the par value, and we'll talk about a few of those examples later on. Bonds are often classified according to the type of issuer. So who is the borrower? Who's trying to get money? Treasury bonds. So the US Treasury is the one borrowing money. Federal agency bonds, municipal bonds, such as counties and cities, and corporate bonds, so companies who are trying to borrow money. Most bonds have maturities of between 10 and 30 years. So that's why we're calling them long-term. They can be issued as bearer bonds or registered bonds. Registered bonds means they are registered and records are kept, and people can trade those bonds electronically because they are registered. Bearer bonds, whoever actually has the bonds in their possession is the owner of those bonds. It's actual certificates, and whoever has those is the owner of those bonds. If they get burnt in a fire, that could be an issue. And so those are bearer bonds. Most bonds that you'll face in your life are registered bonds. Bonds are issued in the primary market through a telecommunications network. And we will show you a diagram here, Exhibit 7.1, just showing how bond markets facilitate the flow of funds. So we've got households and institutional investors on the left-hand side. They've got money. Then in the middle, we've got the US Treasury, federal agencies, municipalities, and corporations who need money. And they're going to use the money on, the US Treasury will spend on government programs, federal agencies, purchases of mortgages originated by financial institutions. So Freddie Mac and Fannie Mae are two government agencies that would do that. Municipalities will spend on state and local government programs, and then corporations will spend to expand their operations. So the money flows from left to right. So those investors or households who want to buy corporate bonds will buy the bond, and then the corporations will use the funds. And likewise for these other institutions. Okay, so what about institutional participation in bond markets? Commercial banks, savings institutions, and finance companies will commonly issue bonds in order to raise capital to support their operations. And we'll look at a couple of examples here in just a second. As investors, commercial banks, savings institutions, bond mutual funds, insurance companies, and pension funds will all participate in the bond market as investors. So not only do they raise funds, but they can invest funds. Exhibit 7.2, and this comes is also in your book. It shows the different financial institutions and how they might participate in the bond market. So for instance, a mutual fund could use funds received from the sale of shares to purchase bonds. Some bond mutual funds specialize in particular types of bonds, while others invest in all types. So maybe there's a government bond mutual fund, and investors want a professional money manager to run this bond portfolio for them, so they'll invest in the mutual fund. Then the professional money manager who's running the mutual fund will take the proceeds of the sale of shares of the mutual fund and then invest those monies in bonds. Moving on, we're going to talk about bond yields. So first, we'll look at yield from the issuer's perspective. Yield is the rate of return. It's commonly measured by the issuer as yield to maturity. So what is the rate that's being paid up until maturity? And we'll look at yield a little bit more closely as we get into this. So the yield to maturity is the annualized discount rate that equates the future coupon and principal payments to the initial proceeds received from the bond offering. So if you took my Finance 3250 class, we did quite a bit of work with bonds, valuing bonds, determining what the yield is. And so the yield is determined by the coupon rate, the principal payment, and the initial cost of the bond. And so it may not be just the coupon rate, it may be something different, because maybe you bought the bond at a discount or at a premium. And so the yield is the actual real return that is paid or received. So what about the yield from the investor's perspective? Investors would look at the holding period return because most of the time bond investors, or a lot of the time, I mean, these are long-term 10 to 30-year bonds, they may not hold the bond until maturity. So they'll buy the bond and they'll sell it at some future date, but it's typically before the bond matures. And so investors are just looking at, well, what is my yield until I sell it? And the yield consists of two components. First, a set of coupon payments. So there's a stream of cash flows coming off of that bond. It's paying a regular coupon payment, and there's a value to that. And then the second is the difference between the par value that the issuer must pay to investors at maturity and the price it received when selling the bonds. Okay, so again, the par value is what's paid at the end when it matures, but the selling price before and during, before it matures, can be different. And so the yield will consist of not only the coupon payments, but the difference in price that is paid and then received. Now let's talk a little bit about Treasury and federal agency bonds. So the US Treasury will commonly issue Treasury notes and Treasury bonds to finance federal government expenditures. So they raise funds. The minimum denomination for Treasury notes and bonds is now 100. You'll often hear 1,000. Note maturities are less than 10 years, whereas bond maturities are 10 years or more. So it's not uncommon to see 30-year Treasury bonds. Last lecture, when we were talking about money markets, we talked about Treasury bills, and those are less than a year. So less than a year is Treasury bills or T-bills. From a year to 10 years are Treasury notes, and more than 10 years are Treasury bonds. They pay semi-annual interest payments from the Treasury. Interest is taxed by the federal government as ordinary income. So you lend the money and then they pay you interest and then they tax you on that interest. But it is exempt from any state and local taxes. So how are these bonds issued? Treasury bond auctions are the way that it's normally held. They're normally held in the middle of each quarter. Financial institutions will submit bids for their own accounts or for the accounts of their clients. Bids are submitted on a competitive or a non-competitive basis. So what's the difference between competitive and non-competitive? Competitive bids specify a price and a dollar amount of securities to be purchased. So the person who is bidding, who's trying to buy bonds, will specify a price that they want to buy them for and how much they want to buy. Non-competitive bids only look at how much, the dollar amount. So let's say I had $100,000 to invest in treasury bonds. With a non-competitive bid, I would just say I've got $100,000 and I'll buy however many bonds I can buy for $100,000. With a competitive bid, we're also looking at price. So looking at trying to pinpoint a specific cost of the bond. So what about trading treasury bonds? Well, there are bond dealers that serve as intermediaries in the secondary market. So the treasury will sell the bond, typically to institutional investors, and then those institutional investors won't hold them forever, and they will then resell the bonds, and they're sold on the secondary market. So these bond dealers match buyers and sellers of treasury bonds. The dealers profit from what we call the spread, this is the difference between the bid and the ask price. So the buyer is bidding an amount, the seller is asking an amount, and there's going to be a difference there, and the difference is goes to the dealer as profit. Treasury bonds are registered at the New York Stock Exchange, but the secondary market trading occurs over the counter. So this can be done in online trading. Investors can buy bonds through the Treasury Direct program as well. There are online quotations. Treasury bond prices are accessible online at investinginbonds.com. I encourage you to go on and take a look at these two websites. So the title of this next section, I assure you this is a clean lecture. They're called stripped treasury bonds. So the anatomy of a bond, you'll remember there's the payments, you've got interest payments or coupon payments that are paid semi-annually typically. And then at the end, the bond is paid back. So if it was a $1,000 bond, over the life of the bond, the Treasury will pay interest payments, and then at the end, at the maturity of the bond, they will pay back the $1,000. Well, what we see here is the cash flow of bonds are commonly transformed or stripped off by securities firms to create principal only and interest only bonds. So they're stripped apart. So now we've got two separate streams of payment. One is the regular interest payments. The other is the actual principal that will be paid back at the maturity of the bond. So now the securities firms can sell either a stream of payments or just sell a lump sum that will be paid back at a future date. So stripped treasury securities are commonly called strips, separate trading of registered interest and principal of securities. So you can see treasury strips being sold, and so they're separately. Strips are not issued by the Treasury, but instead are created and sold by various financial institutions. The next concept, and these are issued by the Treasury, are inflation-indexed Treasury bonds. And they provide returns that are tied to the inflation rate. So one issue that fixed income or bond investors have is, well, what happens when interest rates go up? When interest rates go up, then the value of an existing bond goes down because it's paying a lower interest rate than the new interest rate. So what the Treasury has come up with is a type of bond. They're called Treasury inflation protected securities, which are tied to the inflation rate. So if inflation goes up, then the interest payments will go up. And this is to protect investors from potential changes in interest rates, or sorry, inflation rate, which could harm them. So the principal value is increased by the amount of the US inflation rate. In this case, it hasn't really worked out very well lately. Inflation has been fairly low, artificially so, many will say, because of the Fed and the things that they've done. And so investors in TIPS haven't seen very many big wins. But if you believe that the inflation rate will rise substantially, which it is possible, then TIPS might be a good potential investment. The next type of bond are called savings bonds. They're issued by the Treasury, but they can be purchased from many financial institutions. So some banks, you can go buy a savings bond from your local bank. It can be purchased with as little as $25. So this, your grandma might go and buy you a savings bond, a $25 savings bond, and it's paying some ridiculously low interest amount. Interest income on savings bond is not subject to state and local taxes, but it is subject to federal taxes. Now let's talk about federal agency bonds. So this is different than the Treasury. These are agencies. And the federal agency bonds, the agencies that are issuing these bonds are Federal National Mortgage Association, Fannie Mae is what we call it, and the Federal Home Loan Mortgage Association, Freddie Mac. And they use these proceeds to purchase mortgages on the secondary market. So if I take out a loan on my house, let's say I do it through Quicken Loans. Quicken Loans can decide they want, want to sell that mortgage, and they'll typically sell it to somebody like Fannie Mae or Freddie Mac, who will use the proceeds from their bonds to buy these on the secondary market. During the credit crisis in 2008, Fannie Mae and Freddie Mac experienced major financial problems because they'd purchased a bunch of risky subprime mortgages that had a high frequency of defaults. And the federal government rescued Fannie Mae and Freddie Mac so that they could resume issuing bonds and continue to channel funds into the mortgage market. So we had the Treasury, we had federal agency bonds. Now we're going to look at municipal bonds. So these could be state, county, or city bonds. They're issued by state and local governments. There are a couple of different types of municipal bonds that are issued. One is general obligation bonds. These bonds are supported by the municipal government's ability to tax. So it's just the fact that the municipality can charge taxes. They're going to use that tax to pay back the general obligation bond. It's just a general obligation of the county, state, or city. Then there are revenue bonds. Now these are supported by revenues of a particular project. It could be a tollway, a toll bridge, a state college dormitory. In southern Utah, you could see them being used to finance golf courses. And so the revenues off of these things, for instance, the golf course revenues would be used to pay back the bonds. They typically promise semi-annual interest payments with minimum denomination of municipal bonds typically being at 5,000. Most municipal bonds contain what we call a call provision. So the municipality would have the right to pay back the bond early so they can stop paying interest payments. So let's say the tollway was a lot more successful than they had expected. They have a lot more revenue. They could pay back the bond early. The call provision allows them to do it without penalty. Credit risk of municipal bonds. Municipal bonds do have potential risk. There are some high profile examples over the course of the years. Back in 1994, Orange County in California had to file bankruptcy because they had made some bad investment decisions and defaulted on their debt. And so what we have nowadays is a rating of municipal bonds to determine what is the credit risk of the bonds. Companies like Moody's, Standards & Poor's, and Fitch Investors Service assign a rating to the municipal bonds based on the ability of the issuer to repay the debt. So how likely are they going to be able to pay back the debt? Insurance, there is insurance available on municipal bonds. Some municipal bonds are insured to protect against default. And I've worked with clients, as I mentioned before, I worked in the investment industry for a number of years, and I had clients who had purchased insured municipal bonds. There are also variable rate municipal bonds. These have a floating interest rate that is based on a benchmark interest rate, so that could go up or down depending on rates. The benchmark interest rate today is extremely low, so those who'd invested in variable rate municipal bonds probably are kicking themselves right now. If we see interest rates rise, that'll be a good thing for these types of bonds. There are some significant tax advantages of municipal bonds. Interest income is normally exempt from federal taxes, which is the lion's share of the type of taxes that investors will pay. So the tax exempt nature of municipal bonds is very attractive. Interest income within a particular state is normally exempt from the income taxes, if any, of that state. So within the state of Utah, typically, if there's a municipal bond that's issued within the state of Utah, investors wouldn't have to pay the state tax as well. So then it would be completely tax exempt, both federal and state tax exempt. So how are these traded and how are they quoted? Today, and this was as of 2018, there are more than 1 million different municipal bonds outstanding and more than 50,000 different issuers. So there are a lot of municipal bonds out there. However, many municipal bonds have inactive secondary markets. There's not a ready buyer for it. I had an investor who became my client. They had already purchased a revenue bond. It was a golf course bond in Southern California. They wanted to sell it. And so working with some bond dealers, we tried to sell it. It took us about 3 months before we found a buyer for the bond. So that's very inactive, makes it fairly illiquid. However, electronic trading of municipal bonds has become very popular, making it easier and slightly more liquid than it has been in the past. So what affects the yields offered on municipal bonds? The municipal bond must pay a risk premium to compensate for the possibility of default. Second, the municipal bond must pay a slight premium to compensate for being less liquid than treasury bonds. So there's an illiquidity premium for those that are at the same maturity as treasury bonds. The income earned from a municipal bond is exempt from federal taxes, allowing municipal bonds to offer a lower yield than treasury bonds. And you'll see this. A typical municipal bond, while it has to pay a risk premium and a liquidity premium, they can often still be yielding less. This is a pre-tax yield, not the tax exempt. A tax exempt, when you take into account the tax savings, they can be very attractive versus treasury bonds. So here is Exhibit 7.3, which shows the yield offered on general obligation municipal bonds over time. You can see the general decline in the rate over the years, and we've seen it continue to deteriorate as interest rates have been kept artificially low across the nation and throughout the world. The shaded areas are US recessions, but you can see there's some volatility in municipal bonds over the years. 1995, right in this area, this is where the Orange County defaulted on their bonds. Okay, so now we've talked about federal bonds, federal agencies, treasury bonds. and municipal bonds. Now we'll jump to corporate bonds. So these are bonds that are issued by corporations. They're long-term debt securities issued by corporations that promise the owner coupon payments on a semi-annual basis. So whoever owns the bond, they will receive those coupon payments. Minimum denomination is $1,000. Maturity is typically between 10 and 30 years. Interest paid by the corporation to investors is tax deductible to the corporation. Interest income earned on corporate bonds represents ordinary income to the bondholders and is therefore subject to federal taxes and to state taxes. So the fact that it is taxed both at the federal and state level affects the rate at which corporations can offer bonds at. So we'll talk a little bit about the corporate bond offerings. There's the public offering. This is when it's sold out to the general public. Underwriters try to place newly issued bonds with institutional investors. So they'll sell them to institutional investors. Some corporations attempt to time their bond offerings when market interest rates are low, such as right now. You'll see a lot of corporations trying to issue bonds during times where interest rates are low, so that their cost of financing with bonds will remain low. When companies have outstanding bonds at high interest rates and interest rates drop, they'll typically issue new bonds so that they can pay back their old bonds and they can refinance. It's almost like refinancing a mortgage. So that's public offering. Then we also have private placement. This is small firms that borrow small amounts of funds, such as 30 million, may consider private placements rather than public offerings. The institutional investors that purchase a private placement include insurance companies, pension funds, and bond mutual funds. They don't always have to be small, though. Warren Buffett has dealt with private placements successfully, and he's dealt in multiple billions of dollars, not just tens of millions. What about credit risk of corporate bonds? Corporate bonds are subject to the risk of default. Companies may not be able to pay it back. So the yield paid to investors contains a risk premium because of that fact. So we also have bond ratings as a measure of credit risk for corporate bonds. However, the corporations have to hire a rating agency to have their bonds rated. You can see there's a potential conflict of interest here. The corporation is paying the rating agency to rate their bond. So the rating agency might have an incentive to give the company a higher rating than they deserve. In general, higher rated bonds can have a higher price, meaning pay a lower yield, because they're perceived to have lower credit risk. As I've mentioned before, I believe in this class, there are a couple of companies that have a AAA credit rating, whereas the US government has a AA credit rating. So there are some very strong and very credit-worthy companies. In 2010, because of the credit crisis that we had faced, there was financial reform. The Financial Reform Act of 2010 affected credit rating agencies. Now they're subject to oversight by a newly established Office of Credit Ratings, housed within the SEC, Securities and Exchange Commission. This is to make sure that the conflicts of interest that are inherent here, because corporations are hiring the rating agencies and paying the rating agencies, that the ratings are still legitimate, not just purchased. There are a type of bond that are called junk bonds. These are corporate bonds that are perceived as very high risk. There's a chance that you will not ever get paid back if you buy the bond. Primary investors in these types of bonds are mutual funds, life insurance companies, and pension funds. So, and they're purchasing these bonds, understanding the risk, and hoping that as a result of offering a higher yield, they'll be compensated for that risk. Okay, so here are the risk premiums of junk bonds versus other corporate bonds over time. So the blue line is AAA rated. So these are the most credit worthy, least likely to default. And you can see the yield has just kind of ticked down a little bit, but no big fluctuations as we can see here. Look at junk bonds though. These are the high yield, and that's a term that you'll hear. So if you're looking at a list of bond mutual funds, a better way of saying junk bond, because nobody wants to buy junk, is high yield. So that's the way they package it to sound a little bit better. But you can see the risk premiums of these bonds shot way up during the credit crisis. It's come back down, but you're going to get a higher yield because you're taking higher risk than the AAA. There is an active secondary market for corporate bonds. The dealer broker bonds between buyers and sellers. And so there's a dealer there that helps connect buyers and sellers. Bonds issued by large, well-known firms are liquid. If you bought, I don't know if Amazon has bonds outstanding, but if you bought an Amazon bond, everybody knows Amazon, and they're well-known, and so those bonds would have a ready liquid market. However, bonds issued by smaller, lesser-known firms are less liquid, very similar to what I mentioned with municipal bonds. And so you have to watch out that you're not stuck in something when you need to sell it. There's an electronic bonds network that matches institutional investors that wish to sell some bond holdings or purchase additional bonds in the over-the-counter bond market at a lower transaction cost. So electronics or technology has brought the cost of trading in these bonds much lower. So there are a couple of different types of orders through brokers. So if you called up your broker and said, hey, I want to buy the new J&J bond, Johnson & Johnson bond. And the broker will say, well, do you want to do a market order or a limit order? And so the market order, the transaction will occur at whatever the prevailing market price is. So you're not stating, I want to buy it at X price. You put in the order and it'll fill at whatever the current price is. And so the price will fluctuate and it'll be a little different than what you had thought. You know, probably just pennies, but still the market order, as the market moves, it'll affect the price you pay. On the other hand, you've got a limit order, and this transaction will only occur if the price reaches the specified limit. So, and there are different ways of putting in limit orders, but that's when an investor is targeting a specific price. So you could say, oh, well, I want to buy the bond if it drops to X $1,000. And on the sell side, you can do the same thing. You can do a market order or a limit order. I'll sell the bond once it reaches up to a certain price. It may not ever reach that, and your limit order would never be filled. A market order is always filled. A limit order is only filled if it hits the price that has been specified. More orders to buy and sell corporate bonds are being placed online. Some online bond brokerage services now charge a commission instead of posting a bid and ask spread. So you'll remember before we talked about bid and ask. The difference between bid and ask is what a traditional broker would receive, but now some are just doing a flat charge commission on the purchase. So what are some of the characteristics of corporate bonds? One is what we call a sinking fund provision, and this requires that the firm retire a certain amount of the bond issue each year. So they have to pay back a certain amount of what they borrowed every year. That way, at the end, when the bonds mature, you don't still owe all of it. Sometimes the company may have a difficulty coming up with all the money to pay it all back at the same time. There are also protective covenants. These are restrictions placed on the issuing firm that are designed to protect bondholders from being exposed to increasing risk during the investment period. So, for instance, some bonds might have a protective covenant that would restrict the company from borrowing too much. So, and if they want to borrow more than that, they can't. They're stuck, they're restricted. And so that would protect the existing bondholders from additional exposure to credit risk. There are also call provisions, sometimes with corporate bonds. The call provisions normally require a price above par value when bonds are called. So if a company says, well, we've got all this cash, why don't we just pay back our bonds? And if they have a call provision, they're able to call those bonds, but they have to pay more than the par value. The difference between the bond's call price and the par value is what we call the call premium. So they have to pay a premium to pay it back early. It's a prepayment penalty, basically. If market interest rates decline, the firm may sell a new issue of bonds, as I mentioned, with a lower interest rate and use the proceeds to retire the previous issue by calling the old bonds. Also, bonds could be collateralized, meaning there could be collateral that protects them. They can be classified according to whether they're secured by collateral and by the nature of that collateral. So maybe a bond is secured by a large piece of property, or for instance, with the golf course, the bond is probably also secured by the golf course itself. There are also unsecured bonds, which are a little bit more risky. If there's a default, there's nothing to fall back on. Whereas with those that have collateral, if they fail to pay and default on the bond, then the bondholders can take the collateral. There are also low and zero coupon bonds. And these bonds don't pay interest. A zero coupon bond doesn't pay interest. And so the bonds are issued at a steep discount from par value. So if it's $1,000 bond and it's a zero coupon bond, it's not going to pay any interest during the life of the bond. And so the bond might be sold, say, at $800. And so the investor buys it at $800, and then at the maturity will receive $1,000. They're purchased mainly for tax-exempt investment accounts. So taxes have a lot to do with the way people invest. And so there are different motivations. There are also variable rate bonds. We talked about municipal bonds that are variable rate. These are similar. They're long-term debt securities with a coupon rate that is periodically adjusted, usually tying it to some index interest rate. Finally, we've got convertibility. We can change the bond into stock. A convertible bond allows investors to exchange the bond for a stated number of shares of the firm's common stock. And you'd only want to do this if you felt the stock was going up, and you could see that the value of your bond versus the stock was such that it would be better to be holding on to stock. So how do corporate So we're going to talk now about how corporate bonds finance restructurings. The first is using bonds to finance a leveraged buyout. So this is when the proceeds from debt are used to buy the outstanding shares of stock, so that the firm is owned by a small number of owners. So a lot of scenarios where a leveraged buyout can be used. I've got a close friend who is the CEO of a $7 billion private equity fund, and most of their purchases are done using leverage. So they'll issue debt that could be bonds or it could be other forms of debt, and they will buy those shares of stock using leverage. They could also use bonds to revise the capital structure. Debt is normally perceived to be a cheaper source of capital than equity, as long as the corporation can meet its debt payments. So in some cases, corporations issue bonds and then use the proceeds to repurchase some of their existing stock. This strategy is referred to as a debt for equity swap. And there is an optimal debt to equity level that every company is trying to reach. And the reason being is debt is typically a cheaper source of capital. Next, we're going to discuss CDOs, collateralized debt obligations. And these are when corporate bonds are packaged by commercial banks into collateralized debt obligations. So they're securities that investors can invest in, which are backed by these bonds. Investors receive the interest or principal payments generated by the debt securities. Some CDOs also contain other types of debt, such as credit card loans, car loans, and commercial or residential mortgages. These CDOs, when you include some of these, credit card loans, commercial or residential mortgages, these were the types of CDOs that really struggled during the credit crisis, because people quit paying their credit cards and their car loans and quit paying their mortgages. And so that was a real struggle for the CDOs during that time. CDO is segmented into slices that we call tranches. It's not tranches, it's tranches. And cash flows are prioritized by seniority. So each tranche, it's rated by a credit rating agency. So even though you've got this one CDO, there's segments or slices, the tranches are rated individually. Senior tranches may receive a very high credit rating, so a good credit rating, whereas tranches with lower priority receive lower credit ratings. The investment in a tranche is priced to generate an expected return to investors that compensates them for their risk. So the lower the priority, the lower the credit rating, the higher you would expect to be compensated because of the additional risk. Next, let's talk about global government debt markets. So bonds are not only issued by the US government, bonds are issued by foreign governments, and they can be attractive to investors because of the government's ability to meet debt obligations. So assuming the government is strong, the country is a healthy economically, there may be some attraction to investing in other government bonds, and maybe they've got a higher yield. We've seen crises as well, though, in international bonds. The Greek debt crisis is one of them. In 2010, Greece experienced a debt crisis brought on by weak economic conditions and a large government budget deficit. They were spending more than they were earning, and then the economy got hit hard. So credit ratings on Greece bonds were reduced several times. And these concerns also spread to other parts of the European Union, including Spain and Portugal and Ireland. And you can see this here. We've got the risk premiums on debt issued by governments of the Eurozone countries. Ireland is green, Portugal is red, Italy is blue, Spain is yellow. Greece, you can see their risk premium jumped way high, and a very difficult time for these countries. Now let's talk about the Eurobond market. An underwriting syndicate of securities firms can participate in the Eurobond market by placing the bonds issued. The issuer of Eurobonds can choose the currency in which the bonds are denominated. So Eurobonds are not denominated in US dollars, but in some other currency. There are other types of long-term debt securities you may want to read about in the book. Structured notes. I've dealt in some structured notes. There's a significant amount of risk with those. Exchange traded notes and auction rate securities. So just to summarize, bonds are issued to finance government expenditures, housing, and corporate expenditures. Many financial institutions, such as commercial banks, issue bonds to finance their operations. In addition, most types of financial institutions are major investors in bonds, whether for themselves or representing their clients. Bonds can be classified in four categories according to the type of issuer. So treasury bonds, federal agency bonds, municipal bonds, and corporate bonds. The issuers are perceived to have different levels of credit risk. In addition, the bonds have different degrees of liquidity and different provisions. So you really need to pay attention to those different provisions and these differences between the bonds. Thus, quoted yields at a given point in time will vary across the different bonds and bond issuers. Bond yields vary among countries as well. Investors are attracted to high bond yields in foreign countries, causing funds to flow to those countries. Consequently, bond markets have become globally integrated. And I did have several instances where we invested in international bonds for our clients. Structured notes are long-term debt instruments that allow investors to bet indirectly on or against a specific market that they cannot bet on directly because of restrictions. So they're tied to a specific market. Exchange traded notes are debt instruments in which the issuer promises to pay a return based on the performance of a specific debt index after deducting specific fees. They are not legally defined as mutual funds and therefore are not subject to mutual fund regulations. They also have more flexibility to use leverage, so they can borrow money to buy more securities, can achieve higher returns for investors, but also can result in higher risk. With that, we've finished our Chapter 7 lecture. If you have any questions about any of this, please feel free to give me a call or shoot me an email. And hopefully it all makes sense, and I appreciate you listening. Thank you very much.